Hi, I'm Brock.
I'm Jim.
Before we get started, if you want to stay ahead of the cattle markets, sign up for our free daily briefing at herdadvisor.com. It's delivered right to your inbox every morning, 5-minute read. And if you've ever wished you could keep complete cattle records without the clipboard, the Cattle Record Guide lets you enter records from the field with your gloves on. Just say, "Hey Siri, try it free for 14 days at herdadvisor.com.
All right, welcome back to Cattle Market Guys. I'm Brock, that's Jim, and we've got a busy one today. So let's start with the snapshot. Looking at the numbers for the week of August 16th, the 500 to 549 weight steers came in at $402.94 per hundredweight. That's down $3.31 from the prior week. And if you zoom out to the monthly view, we're down $22.47 from $425.41 back in mid-July. That's a real correction happening in the lighter end of the market.
Well, that's a chunk of change disappearing in a month. Reminds me of watching the gas gauge drop on an old truck with a bad fuel line.
And it's not just the lighter cattle. The 600 to 649 weight steers are sitting at $364.07, down $7.46 week over week, and down $21.23 from a month ago when they were at $385.30. According to the forecast data, the 1-week outlook has that weight class dropping further to $337.70 before the 4-week projection shows a slight recovery to $346.16. So we're looking at continued softness in the near term with maybe some stabilization by mid-September.
So we ride out the dip for a few weeks and hope it levels off. Got it.
That's a fair way to put it. Now, volume's been pretty average across both weight classes, so this isn't a thin market anomaly. This is real price movement on real numbers. And I think part of what's driving this ties directly into the news that broke today, which we'll get into in the next segment. The article from the cattle site noted that CME live and feeder cattle futures were mixed following the tariff announcement, with traders adjusting positions ahead of the USDA cattle report. Interesting side note, hog futures actually rose as pork carcass values gained $1.47. So there's some cross currents in the broader protein complex right now.
Funny how pork's having a good day right when we're taking the hit. That's just how these markets go sometimes.
It is. All right, let's dig into what's actually moving these markets because there's a lot to unpack here.
Let's do it.
So the big story today is that President Trump announced a temporary waiver on higher beef tariffs, specifically expanding the tariff-free import quota by 300,000 metric tons for a 90-day window. The stated goal, according to his post and the reporting from Beef Magazine, is to lower consumer beef prices. And he specifically cited record beef price increases, along with what he called the smallest U.S. cattle herd in modern history. Now, the reaction from cattle producer groups has been swift and pretty negative. The concern is that flooding the market with imported product right now undermines the herd rebuilding effort that's been years in the making. Jim, this feels like something you might have seen play out before, doesn't it?
Back in '86, Washington pulled almost this exact same move. I remember it clear as day.
Tell me about it.
Well, the government decided the best way to fix high grocery store beef prices was just to open the door wider on imported meat. We'd just spent 3-4 years clawing our way back after that liquidation in the early 80s, finally starting to see some daylight in calf prices, and then here comes a policy move that had nothing to do with what was actually happening on the ranch. Futures took a hit almost overnight, and a lot of us at the sale barn that fall were shaking our heads wondering who was really setting these prices anymore.
And what happened after that, if you recall?
Feeder prices stayed soft for a good several months, but domestic supply was just too tight. By the next year, prices came right back around because there weren't enough cattle to go around no matter how much you imported.
That's a pretty important historical parallel because the fundamentals today are arguably even tighter than they were in '86. And this ties into something else worth mentioning, an article out of Cattle Range that breaks down the economics here. Back in 1980, cattle producers captured 63 cents of every retail beef dollar. By 2021, that number had fallen to just 37 cents, with packers and retailers now splitting the majority of that dollar. So even with record high retail beef prices, producers aren't necessarily the ones benefiting, which makes this tariff move feel like a double hit. Consumers see high prices, producers get blamed, but the margin capture has shifted dramatically away from the ranch over 4 decades.
That's the part that gets me. Folks see beef prices at the store and think we're all driving new trucks out here. Meanwhile, half of us are still nursing along equipment that should have been retired a decade ago.
It's a structural issue that predates this administration by a long shot, but the timing of this waiver is what's rattling the futures market right now. Traders are trying to price in both the near-term import bump and the longer-term reality that U.S. herd numbers are still historically low. My read on this is that Jim's history lesson probably holds up. We'll likely see some short-term softness in feeder prices as the market digests the psychological impact of this announcement, but the underlying supply tightness doesn't just go away because of a 90-day waiver.
No, the numbers just don't support a quick fix, no matter how much you import.
Well said. Let's shift over to another supply side issue that's just as important, maybe more so long-term, and that's what's happening on the Mexican border with cattle imports and this screwworm situation.
Now this one's got my attention.
So context here, the U.S. and Mexico cattle trade is in the process of resuming after a lengthy border closure, and there was a lot of anticipation around that because Mexican feeder cattle have historically been an important supply source, especially for the Southwest and into feedlots further north. Beef Magazine's analysis suggests there's still real speculation on both sides of the border about how fast this resumes, what volume we're talking about, and what type of cattle will actually move. Cattle Range put out an estimate suggesting somewhere around 150,000 head of Mexican imports by the end of 2026, which honestly isn't a massive number relative to total U.S. supply, but every bit matters right now given how tight things are.
150,000 head sure sounds like a lot until you remember how big this whole business really is.
Exactly. It's a drop in the bucket relative to total U.S. cattle numbers, but on the margin in a supply-constrained environment, it matters. Now, here's the complication. Right as this reopening process is gaining momentum, we're seeing new screwworm detections pop up in Mexico. There was a case confirmed in Ciudad Juarez, which raises real questions about the pace of reopening, specifically because of the proximity to the border and the focus that puts on Chihuahua State. And separately, Mexico confirmed its first screwworm case in Sonora, specifically in the municipality of Alamos in the southern part of that state. Sonora's governor, Alfonso Durazo, activated emergency surveillance and containment protocols pretty quickly after that detection.
Screwworm's nothing to mess around with. That's the kind of thing that can shut a whole trade lane down overnight.
Right, and the numbers back that concern up. According to the weekly detection report for the week ending August 19th, confirmed screwworm cases rose to 46, up from 45 the previous week. Now that's not an explosive increase, but it's a steady climb, and any upward trend in confirmed cases is going to make USDA and animal health officials nervous about how fast they can responsibly reopen that border to live cattle movement. Jim, did you ever deal with anything like this out in West Texas?
Not really. Screwworm wasn't something we dealt with much out our way, but I'll tell you, anytime disease gets mixed in with trade policy, things move slower than everybody wants, and usually for good reason.
That's the tension here. You've got a market desperate for more feeder cattle supply and a biosecurity risk that could justify a much more cautious, slower reopening than the market's been hoping for. If screwworm detections keep climbing, I think you have to pencil in delays to that 150,000 head estimate, not an expansion of it.
When it's something that can spread through a herd that fast, you don't rush the reopening.
Agreed. All right, let's close out with the supply and packing side of things because this really ties the whole episode together.
This is the one that affects everybody eventually.
So the USDA cattle on feed report is a big focus this week. As of August 1st, cattle on feed came in at 11.12 million head, which is described in the report as slightly lower than the prior period, though the year-over-year framing still shows things up around 2% according to some of the estimate previews. What's really catching my eye, though, is the marketings data. July marketings were the lowest for that month since the data series began back in 1996. That's not a small statistic. That's the lowest July marketings in 30 years of record keeping. Jim, 1996 rings a bell for you for a whole different reason, doesn't it?
And that drought out here got so bad I sold calves I'd normally have kept another 60 days just to keep from running out of grass and water. Half the ranchers I knew were doing the same, dumping cattle early because there just wasn't a choice. Well, 2 years later, everybody felt it on the other end. There weren't enough cattle coming through the system, and I remember hearing about packing plants cutting shifts, even shutting down lines because they couldn't run at the capacity they needed with numbers that tight.
And that's playing out again in a different form today. We're seeing real structural changes on the packing side right now. Tyson Foods is closing its beef plant in Joslin, Illinois, directly tied to these historically tight cattle supplies. Commercial red meat production is down 2% year over year, with beef, veal, and lamb production all lower, while pork actually moved higher. And when you layer in that feeder and stocker, cattle marketings are running 29.8% below the 3-year average. You start to see a very consistent picture. Supply is tight, marketings are unusually light, and packers are responding by cutting capacity rather than competing harder for fewer available cattle.
Well, if what happened in '98 taught us anything, tight supply eventually finds its way to the packer's door, and they end up paying up whether they like it or not.
That's exactly the dynamic to watch heading into the fall. If placements stay light and marketing stay historically slow, that Joslin plant closure might just be the first domino, not the last. Producers should be watching cattle on feed data closely over the next couple months because the combination of tight fed supply and packer restructuring usually shifts leverage back toward the seller eventually, even if right now the tariff news and screwworm uncertainty are clouding the picture.
This business tends to reward the ones who can wait it out. Always has.
Well said. That's a wrap for today's Tuesday update. We covered a lot of ground: the tariff waiver, the Mexican import and screwworm situation, and the tightening supply picture on the packing side. Thanks for tuning in. We'll catch you next time on Cattle Market Guys.
Take care of your cattle and take care of each other.
That's all for today. Remember to sign up for our free daily briefing at herdadvisor.com. And if you want complete cattle records without the hassle, try the Cattle Record Guide free for 14 days. Enter records from the field with your gloves on. Just say, "Hey Siri."
Catch you in a couple days.
All right, see you then.